Hello, everybody. It is October 19th, Monday, and we're going to go over stocks and options and all sorts of good stuff. Off air, we were talking about different pundits out there, talking about hedge eye, and today I had a couple conversations with others as well. And one of the things that I brought up is that I've lost use for a lot of services that I subscribe to. And between all the newses that I subscribe to, and then these are the services I get that are not professional services. And then I have a whole host of professional services through Interactive Brokers, all sorts of research. And then there's a couple of hedge funds that I talk to on a regular basis. And I got research coming out of my ears, right? So you tend to gravitate towards what you find the most useful, where you can get the most ideas, the best ideas, where the ideas make sense. It's interesting when somebody says to buy something for a particular reason, and then somebody says to buy the same thing, but for a different reason. That's always interesting. And so I pay attention to that sort of thing. And the services that I'm losing interest in are the ones that just keep pounding the whole sound money theories, the whole Austrian economics bandwidth. It just has failed so many times and has never promoted economic growth or an improvement in overall standard of living, which is what economics are all about. That all these folks who talk about, oh, the business cycle means that you got to destroy things and you have to have money that never changes in value. It's just such bullshit because it's never worked that way. Now, we can abuse a monetary system to create too much inflation, for sure, too much debt, absolutely. But that has nothing to do with sound money principles. The reality, and if you've never read Keynes, the general theory, you need to. If you have never read the general theory of employment, interest, and money, you need to read it. If you can get the one with, there's one of these with Paul Krugman does the introduction. You should read that one. That's the issue that I have. It doesn't quite look like that, but this book has been right about almost everything for decades. And everything just keeps coming back to this. You know, he was a superstar investor, by the way. He understood how the cycles worked, why you should spend your way out of a recession, and why you should tighten your belt when things are good. You know, you don't spend a lot of, you don't deficit spend when things are good, which is the thing that we have ignored, right? Every time the economy gets bad, we spend a bunch of money. Okay, that's great, gets us out of a hole. But then when the economy is good, we never pay off those bills. We just wait for the next crisis or next recession, and then we spend a bunch of money again. And over the last 4 years, we spent a bunch of money, deficit spent, even though the economy supposedly was good. As it turns out, we have found out that we were on really thin ice, something that I said in December, January, and February. Coronavirus pushed us through the ice, and because we've handled it poorly, we haven't got back above. So in any case, if you really want to understand money, read this, and then read the general theory, and then read this. And you will know more than 98% of the population. So those are the things that I have seen. And I didn't, when I went into college and when I studied this stuff as a professional, I had no preconceived notions. I didn't care about ideology. I was just learning. And then you compare what's happened over the last 100 or 200 years, and you go, well, this works and this doesn't. And it doesn't mean that, the clock doesn't, the hands on the clock don't go through each time twice, a day. But the reality is that Austrian economics just doesn't work. There is a moment in time where you go, aha, and then it goes away. Austrian economics just does not work, never has worked. And all these crypto anarchists that are tied to it, in the whole cryptocurrency world, it's just all such bullshit. Now they can spike assets and get rich off you. And then when it crashes, go, oh, well, it was something that everybody else did. It wasn't us. I mean, that's what's going to happen with Bitcoin. Bitcoin might go to 1 million. But ultimately, unless people use it to exchange goods and services, it's not going to stick, right? And if the central banks do their own central currencies and they have their own inner exchange of some sort, you're really just speculating on a rush into Bitcoin that may or may not have already happened. I believe that maybe you keep 1% in Bitcoin of your overall net worth, and it represents your bank assets. But the reality is that you're just speculating otherwise, because there isn't really a sound theory behind it. There's not. It's made up out of the ether. It's made up out of nothing. So, you tell me if you want Bitcoin that's based on some theory that an unknown person created or unknown people created, or do you want money based on the entire productive assets of an economy, regardless of how bad the politicians and big business screw things up from time to time? I'd rather have a claim on the productive capacity of an economy and their taxation capacity. So that was what we talked about beforehand, and I talked with some other people. So this week, I wrote a swinging for the fences and also an option selling ideas for income. So you should take a look at those. They are also at margin of safety investing, and we'll go over those real quick here. So swinging for the fences, I took a look at swing trades that could be based on catalysts. And these are some of the earnings that are coming up. Tesla comes up on the 21st. I expect the outlook to be disappointing. So if you do have Tesla, I'd probably take a whole bunch of profits. And I don't see how you can actually own Tesla stock right now. I can see trading options in both directions. I can see taking both a long and a short position because the moves are usually that big. I wouldn't have a big position in Tesla. It's super expensive, and it's probably going to be beat up at some point. The fact that they're paying off their debt by issuing shares, right? That's a lot of dilution, but it leaves the company in better shape. So horse piece there. Eventually, it's going to depend on how many cars they sell. And I'm telling you, there's a different company that you want to invest in. Biogen, also October 21st. Oh, the link didn't work. It's been drifting down. The average move is 7.5% at earnings in either direction. I don't know if it's going to go down, it's going to go up, but I think that most of the biotechs are just kind of treading water again, and they'll probably be part of a broader correction if there is one. Stock that I think that you need to be figuring out a way to get into is Freeport McMoran. Somebody in the chat today asked me, what do I think maybe come down to one stock for infrastructure. Come on, folks. Please just take a couple extra seconds to ask just a little bit more intriguing question. There's a lot of things in infrastructure that are going to do well. But, okay, if I had to break it down to one, I would say Freeport McMoran, because copper looks like it's going to go into shortage in the next year or two. And Freeport McMoran is the biggest producer of copper on the planet. They also have gold, a couple other minerals, but mainly they're copper and gold. So I would be looking as a way to get in here. October 22nd is their earnings. Consensus is 26 cents a share. I'll say they hit 27, but that's still just barely over $1 per year in earnings. It's a cyclical stock, so it means you really shouldn't give it more than a PE of 20, even though at some points it's going to be way higher like it is right now. So I would expect it probably pulls back a little bit, and that might be our chance to get a hold of it. Stock market was down today because they're probably not going to do a stimulus because Mitch McConnell doesn't want to. So, as I said a while back, we might not see a stimulus until February. And that means that a lot of stocks can get beat up between now and then. Freeport McMoran is something to keep an eye on. Remember, don't make the trade until downward momentum is gone. But right now, I'm looking at the December 16 puts for about $2. I think today they were trading for a little over $1. And if I like the 16 strike, if the price is going down hard, you just raise the strike price. Excuse me, the buy price. The sell put. the price that you would sell the put at. So from $2 to $3 to $4, and then you maybe even making a market order. So, when you're using these options, you can't just enter it, set it, forget it, and come back in a week and check. You really do need to check these pretty much 3 times a day, before the open, sometime around lunchtime, and then after the market closes or right before the market closes would be optimal. But Freeport McMoran probably going to do very well in a world that's going to do everything it can to grow its way out of this depression. Sunpower spiked up today, probably is overpriced. We can see that a lot of the estimates have been improved in the last 30 days. One of the things that Zacks does, the main thing that Zacks does is keep track of the analyst estimates, and they know that when analyst estimates are going up, that's usually good. Well, the analyst estimates on this went up, and the stock is almost quadrupled since March. I think that it might be time for a little bit of a pullback. I think the company's probably going to tell us in the earnings that, hey, things look good for the future, but the next 3 to 6 months, might be choppy. I think that would be understandable. I have a hard time believing that the stock can just keep going parabolic the way it has been. That's a pretty good run here. Look at that. Yeah, I talked a lot about this stock over the summer. At this point, I don't want to buy it. I want it to get back. I'd love it for it to get back to around 12. Not so sure that'll happen, but this range in here, I think you probably want to try to add to your holdings. Ford, I've been bombarding the CEO with Twitter messages. I think that they're going to say, whether it's this earnings report or in between or at an investors meeting, at some point, Ford is going to say that everything is going hybrid and EV. And I think 2025, maybe even 2024 is the year. When they make that announcement, and it's a matter of when, not if, it's just a matter of when they say it, the millennials are going to fall in love with this stock. This is one of the top holdings at Robinhood. The stock could very easily go to $30 or $40 a share. Think about what Tesla's done. What if Ford comes out and says, hey, we're going to be a clean energy juggernaut. We're going to invest in clean manufacturing using fourth industrial revolution technology. We're going to take all the small cars and crossovers and make them EVs. We're even going to make the F-150 an EV. And then some of the work trucks will be, hybrids. If they do that, man, you got an awful lot of people not just buying those cars, right, because of all the embedded Ford people, but you've got an awful lot of people buying that stock. So take a look at this. I think you should have a position, and I think that you need to find a way to sell puts. And I have bought some January $10 calls. Why January $10 calls? Couple reasons. One, what if the correction that I keep thinking is coming doesn't come? Two, what if they make this announcement next week? These calls were like 15 cents or something. So if all of a sudden this stock shoots to 12 or 13 because the millennials just love it for a few weeks, now all of a sudden you can turn 15 cents into $2. You can make 1,000% between now and January on this. So I put in less than 1%, only about a 0.5% position, but it's one of these things that's super cheap, doesn't cost you much if you lose, and if you win, you can win huge. The hedges, oil stocks, and the Spider oil and gas EMP ETF. I bought puts on Occidental, Continental, Exxon, and the Spider XOP, all for December. Why December? Because I think the correction happens going into the end of the year. I think it may have started today. Today's the day that I said it would start. Remember, not a couple days ago, Friday, but the Friday before that, I said this options expiration could be the turning point. And the market opened up today pretty healthy, and then pounded down. And the Pelosi news was out yesterday. So it's not like the Pelosi telling them that there was a deadline was brand new. Trump and Pelosi basically have agreed to do the $2.2 trillion. Mitch McConnell's telling them to go pound sand. I'm going to send you a $500 billion bill, right? So anybody who's in a state that has a Republican senator running right now, you really ought to vote against him if you believe there should be stimulus. In any case, I think that all of these are relatively cheap. You have to manage them. Again, they're option positions. You have to manage option positions on a daily basis. Right? Sunpower should come down. Ford is getting ready to break out. You got to buy the dips on that. You got to own some. Don't tell me that you want to wait for it to come down. Buy some now, then buy more later if it goes down. Buy some calls if you're aggressive. Freeport McMoran starting to break out, so you got to buy the dip here down to about 15. If you can sell some of those puts, that's great. Exxon, it looks like it's just going to head down. I think it's going to get down to upper 20s pretty quick. That'll be a double or triple on those options. I want to show you Occidental. They've destroyed this company. Why is it doing that? They've destroyed this company. Came up here and tried to fill the gap. It just has been drifting down. This is clear. Is there anything in this trend that makes you think it's going to start going up? Nothing. It's going to fall off this cliff. I believe that Occidental is going down to well under $5 a share. I think it's going to end up in this range, $1-3. It might go to zero. So I think that you can take a look at it. Everybody wants to wait to get that extra dime. And just sit in front of the computer and look for an hour on an hourly chart where you can get a good deal, right? I was in the chat room at Fundamental Trends telling people to look at this last Friday and today. I think that you need to, if you want to be involved with options, you've got to be involved daily. And like I said, 3 times for sure. So, before the market, lunchtime, and before the market closes. Then you review at night. But this is going to fall off a cliff. So these are pretty good bet against. And Continental sucks. Look at that breakdown. Then look at this breakdown. This breakdown is this one in miniature. So, right? That's what it is. You had the fall, it rose, and then it fell off. You had a fall, it rose, and it's fallen off. I think Continental's another one that goes way down in the single digits. I think that Harold Hamm is going to take it private. One of the things that I talked about here is, you saw ConocoPhillips bought Concho Resources for $0. Think that through. ConocoPhillips bought Concho Resources for $0. They just issued shares of Conoco. So if Concho Resources is one of the best companies in the Permian, and they can't get any cash, what does that tell you about the whole sector? Even the big guys are broke. I think Concho just did the merger so the executives could get their bonus and get the hell out of Dodge. And Conoco took it because, it was basically free. We just issued shares. So I was watching the CEO today on Bloomberg, and he said, everything other than the Permian is now legacy assets. Think that through. Conoco owns assets all over the world. He called them all legacy assets. And he says their decline rate is about 10% per year before the merger. Everybody thought it was 5. And now after the merger, it's 12% decline rate. Think that through. What's the inverse of 1/10? 10 years. They don't have affordable assets. And he talked about demand. He said demand destruction for oil is coming. So all the things that I've been saying, the CEO of ConocoPhillips said it. And I forget the question that the Bloomberg reporter asked him. And he just kind of, it had to do with no cash in the deal is what it was. He just kind of started over his words. Well, by issuing shares, that's a way for the Concho people to participate. If you own Concho, you should be selling it right now. Option selling ideas. Again, Freeport McMoran. You can be more aggressive, buy the stock. But I think selling the puts is pretty easy, right? I'm selling the 16s, trying to get 2. Maybe that goes to 3. Maybe it goes to 4. Who knows? Depends on the momentum. Sunpower, the consensus price target is 13. So I want to try to sell the $15 puts, get $2 or $3 for them, get a net cost down around 12. Ford, again, you should own some. If you don't want to buy calls, sell cash secured puts. I think the $7 ones are pretty good. Covered calls, you write covered calls on anything in here. So I put the list of all the overvalued stocks in the VSL that have been in the VSL in the past or on the VSL now. So you can sell covered calls on everything in here. You could even sell covered calls on Ford, but then I would simultaneously sell cash secured puts because it has been getting some interest. So it might be due for that little pullback. So this is, Ford is something that you could sell. You could buy the stock, you could sell covered calls, you could sell cash secured puts. You could have all sorts of positions in Ford. And then the dividend stocks are way bid up. And you just go through this list. There's so many dividend stocks bid up. Invesco's had a rally. I don't know that I'd sell the covered calls on that. Here's why. Because I think that the management is changing their ways the way that I said they needed to. Now, all those months I was telling you they needed to change. And then an activist investor came in and told them to change. So I would hold off on Invesco until it's up here. Right? One of the things I say here is RSI around 70 and near 52-week high, right? So Ford getting there, right? This is why you probably don't on Ford, but you could. But all these companies that are near 52-week highs, go ahead, fire away on covered calls. Here too. BlackRock, Caterpillar, Costco, Rockwell, Avangrid, I think that's the alternative energy utility. I go right down the list and see all these companies close to their 52-week highs. Lam Research, the semiconductors, Broadcom, I see on here. All of these, ones that are close to their 52-week highs and they're overbought. I think you can sell covered calls on. And again, you don't have to sell a covered call on the entire position, but maybe a third or 2/3 of the position. Okay, so folks ask me what's going on with AT&T every single week. And what do I say every single week? I'm really asking. Warner Brothers, thank you, Tom. AT&T has an incredibly valuable asset that someday somebody's going to buy. In the meantime, it's just not in favor with millennials, and baby boomers are sitting on their wallets. It's just not a sexy stock right now. But as soon as somebody offers them over $100 billion for Warner, and that's what it's going to get, I think it might get 150, it might get 200, might get 250, might get 300. If you're paying attention to what's going on in streaming, what you are realizing is that we're all getting screwed on the streaming services. At this point, we would have all been better off paying $100 a month for an all-inclusive cable package than $10 for this one and $15 for that one and $10 for that one, and still needing some sort of skinny cable package because otherwise you can't get sports. So at some point, Warner is going to get bought because that library is hugely valuable because you need all the space, you need all the content in between new series. And remember, they own HBO, that's part of it. So at some point, they get a studio, they get a library, they get a video game division, which they were talking about already selling and they didn't yet, I don't think. AT&T, after Warner Brothers gets spun out, is going to be an essentially debt-free company, is from what I can tell. Imagine AT&T's revenue and no debt, and their pension's fully funded, so they have no pension problems. AT&T is a stock that you should buy. It should be a core position, 3 or 4% of your holdings, and you just collect that dividend. And even if you're a growth investor, you could probably own that one, right? You hold it in a Roth IRA or an IRA rollover. You collect the dividend, and you spend that money on other stocks, and at some point, the stock triples because they sell Warner Brothers. I mean, the only way it doesn't happen that way is if management is remarkably stupid. And they might be, because idiots run these companies all the time. But Warner Brothers is worth a fortune. And Apple or Google or Microsoft or whoever, Disney maybe even, although I think Disney might get antitrusted if they try to go after another studio. But it's super valuable. And why does AT&T even need it? There's only going to be 4 or 5 5G companies on the whole continent. No. AT&T's bandwidth is fine. They're going to have to add around the edges like everybody else. That's just part of the business. So I told you we're going to do REITs this week, and we kind of are. I'm not ready to unveil the list, but I want to talk to you about REITs in general. So there's this idea that REITs outperform the market. It's not true. Real estate does not outperform the stock market. There we go. All right, so over the last 5 years, VNQ is the REIT index, basically with Vanguard. That pink line is the S&P 500 and the green line is QQQ. And this includes dividends. Have you noticed something? Over the last 5 years, REITs have not outperformed. So let's look at a longer time. This is going back to the bottom day of the financial crisis, March 9th, 2009. QQQ has crushed it. It's kind of been in this topping pattern for a very long time. QQQ, then here's VNQ, right? So VNQ and SPY, since 2009, inclusive of dividends, are about equal and really have performed the same this year. Had the same crash, converged a few years ago, and QQQ up here. Old economy, new economy. Real estate, repeat after me, real estate does not outperform stocks. The reason you use real estate is as a diversifier. It has to do with asset allocation, and to make it work, you have to have good security selection. So the broad REIT investment thesis is this. Because REITs do not outperform stocks, we need to look at REITs as a way to diversify first, and then generate income second. All these folks who look at REITs and say, oh, the income is great and I get growth. Bullshit. You don't get any extra growth. You don't get any extra total return versus the S&P 500. It's trailed over the last 5 years, right? And it's been the same over a longer period. So at this particular moment in history, though, there is, and this is a special economic term here that I'm going to unveil on you. It's an important economic term that doesn't get used nearly enough. Over the last couple of years, and especially this year, a shit ton, okay, special unit of measurement, a shit ton of REITs have gotten the crap kicked out of them. Some of these REITs are going to do really well coming out of this. Sometime between now and rumors of a vaccine, real rumors of a vaccine, these REITs are going to come screaming back. And it depends on which ones. Because certain REITs are going to have such high capex, so much money that they're going to have to spend to remodel, rejigger, flip tenancies, whatever. Some of the REITs are going to take years and years to recover because of the money that they have to put into it. One of those companies is probably Simon Realty, right? Simon Property Group. And the reason I say that is not only do they have to remodel about half of their malls, and there's no way to buy these malls. There's one been sitting vacant in Milwaukee 20 years. In Milwaukee, it's right next to a rich suburb. I mean, literally 10 minutes outside of a rich suburb, there's a mall that used to be the crown jewel of the area that's been vacant for 20 years, maybe longer. So you have all these malls for Simon, and now they're starting to buy retailers just so they have somebody to fill the spaces. Think that through. Maybe the mall model needs just a complete overhaul. Maybe all the malls need to be mixed use, right? Maybe they need to put offices on the second floors and shops on the first floors. Maybe they need to take some of the anchor stores that have disappeared and call Amazon and say, hey, how would you like to put a Whole Foods, and then we'll give you a dock to do Amazon Fresh to the area, right? Because we know the grocer anchored strip malls do pretty well. Maybe the malls need to go to Amazon and say, hey, how'd you like the old Macy's? Whatever. There's a lot of real estate out there that needs so much capex that we have to be careful that we don't get behind these giant debt machines. So at this particular moment in history, there are REITs out there that I think are going to double or triple in the next 5 to 10 years, plus pay a dividend. Some of them don't pay a dividend right now. EPR, we've talked about a little bit. EPR, AMC is their biggest tenant, and they're going to go bankrupt right after the new year. 99%, everybody knows it. So EPR is going to have another hit to their revenues for another year, and then coming into 2022, they have debt due. So EPR might be one of those companies that at $12, $15 a share, whatever it is right now, you say, oh, man, they might not, they probably can't justify $12 to $15 a share for 3 or 4 years. But what if it went down to 2? Well, if it went down to 2, and I was pretty sure it was going to be back to 12 to 15 in 3, 4, 5 years, well, then I'd buy it. But why would I buy something at 12 to 15 thinking in 3 to 5 years it's going to be 12 to 15, right? I buy it at 2 or 3 or 4. I'm not going to buy it, 12 to 15. And I don't even know if those are the right prices, but that's the example still holds. Sometimes you just have to wait for things to be cheap. And a lot of these REITs are going to double bottom. And the ones that don't go through the double bottom probably have good finances and their businesses are probably good enough. But then the other ones are going to fall through. So if you're going to buy before they test the double bottom, you better know which ones are going to bounce and which ones are going to break through, right? And continue to collapse. So based on the old 60-40 portfolio rules of 60% equity and 40% bonds for your general retiree, I'm changing the way that I'm doing it. And you already know that I'm putting 16% in gold and gold miners. It goes as low as 8 if you don't want to do all the way up to 16. But REITs are filling most of that other 20%. So 60% stocks, 16% gold and gold miners, and then 16% REITs. And here's the interesting thing. This isn't just for total return investors. I think because so many of the REITs are dirt cheap, if you're a growth investor, you should have a few REITs as well. And maybe you don't do 16%, maybe you do 8. But if you can find REITs, and I'm telling you that they're out there, if you can find REITs that on this next bottom test, that they're going to double, triple, quadruple in the next 3 to 5 years as the economy recovers, right? There's a lot of money to be made there. A lot of the retail REITs that don't have debt issues are going to do really well coming out of this. And one of the REITs that I'm really digging into is Empire Realty Trust. Owns the Empire State Building and a bunch of other, properties. So you take a look at what they own in Manhattan, and it's pretty interesting. So you ask yourself, do I want one of the premier real estate companies in Manhattan? So I'm going through the properties right now one at a time. And what I'm doing is I'm keeping a ledger. And I'm trying to figure out, okay, about how much are they going to have to spend? And then how much are they going to have to flip tenants? So that's one of the ones that might make the list. Store Capital, you all know Store Capital is on the list. Somebody asked about Store Capital today. And the same thing I've been saying, 26 is what I'm looking for. But if the downward momentum is strong, then down in here, or maybe even down in here again. I mean, it could get down to 20-ish on a good correction for sure. Don't buy when the momentum, right? When this hasn't get on the daily chart, you need this to get down here. On the weekly chart, maybe in here. I mean, this could happen too. But I just, like I said, I've given you all my reasons why I don't think we're going to get all the way to the bottom on certain assets. Not the classes, but there are certain assets that, they have debt problems. Those grandpa stocks that I keep talking about, those old economy stocks I keep talking about, you got to be real careful. But there's certain companies, the quality companies, the companies that have underlying growth, that have valuable assets and don't have debt problems, they're going to do all right. And the debt is something you really have to keep an eye on. Just because they're able to refinance it cheap this time doesn't mean that in a few years they'll be able to refinance it cheap again. All right, let's take a couple of questions and then call it a night. I got pumpkins to carve. KMI, I bought leaps for January 23 on KMI. Oh, I hate that trade. Why would you buy leaps on a company that pays a gigantic dividend? I would just own the stock. I think that's a risky trade. I would take profits on those KMI leaps in the first second you got. Well, then don't buy anymore. KMI is a 1 or 2% position, right? It's not quite as good as AT&T, but it pays a gigantic dividend. So in your basket of dividend stocks, KMI can be in there. So when you want to, let's just give me a symbol, one of those Schwab ones. It's just the one that mimics QQQ. Yeah. So fib retracement is the important one. And let's go back to that time frame that I keep telling you is important. The market has keyed off of Trump's election. And with all the money printing, it might not happen, but it could. The bottom of the market is those 2015-16 levels. So you have the market turnover here, and then here's your pivot point. You pull it up to where it pivots down. So that's right there, okay? So that's your first one. That's your longer term one. And then the extension is the same thing from the bottom pivot to the top pivot to the next down bottom pivot. Now look at that. This 0.5 fib extension is right where it stopped, okay? I mean, think about that. It didn't have to stop going down there. All right, so here you're at another pivot, always at a pivot. So there, right before the corona crash, the extension from there to the top pivot and then down to here. All right, so let's make this a little bigger and easier to look at. So here's your 0 level. So that's probably what, and it happened, right? And then here it is there. So from here to here, it gets you your 0, comes down and it breaks through. Jitterbugged, always get the jitterbug, then it broke through. So here is probably your first support level. And in a strong market, in an otherwise bullish market, that'll probably hold. I don't know that we are going to have, where's my shapes? There's my shapes. You know, I think you can argue if you're a bull, that's where you're looking. But this entire range is in play, right? That entire range is in play. Look where all these lines are on top of each other, right? A confluence, and it bounced around right in here, and it peaked right there. So this is an important structural area. So I would have to be a buyer if it gets to here and momentum is exhausting. And if it comes all the way down here, I mean, you know, realistically, I mean, you could see, you know, I mean, there's, I forget who it was, but there's somebody out there saying a 70 to 80% crash. Again, I don't believe that just because I think the government comes in and just fire hoses it. But that, you know, how far down does it go before the government has an impact, right? The way I do the colors is the oldest one is this one, and then I skip. Oldest one is this one, and I skip. I go that way. It's just how I remember it. You know, you go all the way across here too. I mean, that's a pretty legitimate range. Come all the way across to here, right? So we're out of the range. It's just a matter of where in the range does it fall. It doesn't fall below the range the way that it went above the range. We'll find out. I tell you what, if there's no stimulus between now and the inauguration, all sorts of crazy things can happen. I mean, those continuing claims with PUA, I think that's what's called, PUA, Pandemic Unemployment Assistance. I think that's what it is. A lot of people hurting for cash. A lot of people losing their jobs that are higher income. So at a minimum, they're not putting money in the market anymore. And the Fed, I showed you in Friday's webinar, I showed you what the Fed is doing. The Fed has firepower, but they don't want to use it for stocks. They're only going to use it if the bond market starts to get clobbered. So as long as the bond market holds up, the Fed's going to let things happen, especially now that we're getting in on top of the election. The Fed's not trying to help Trump anymore. They don't care. It's a done deal. It's over with. This election is so close to being over. You know, what they said that 60, 70% of the votes will be in before election day. I'm turning mine in tomorrow, taking it to the Dropbox. You know, I think that we just have to watch what's going on. I'm not sure why the Republicans don't want to pass a stimulus bill, but, you know, whatever. It's what they don't want to do it. So that means that we can, you know, get closer to this end of the range, right? This is this mimics QQQ. I guess I can compare it, right? Very similar to QQQ. So we could get closer to this end than this end without a stimulus package. And these lines in here where there's all that confluence, right? All these levels are kind of just, it jitterbugs around these areas. Yeah, I think that that's pretty likely. I think the middle of these ranges are pretty likely. I don't know about the bottoms. I think these are all but certain. Do you trust the pools? What do you mean the pools? Polls. I think the polls are understating Biden's lead. I think Biden is going to win by closer to 15 million votes than 10 million. I've been saying 10 million for 2 years now, right? A little over 2 years. Been a long time. I don't remember anymore. Since early 2019, I've been saying Biden or the Democrat would win by 10 million votes. But I've been saying Biden because I bet on him a year ago. I think 10 million votes for Biden. It might be 15. Looks like he's going to win Georgia. I think you're going to see some really shocking outcomes within a few days of the election. And it's going to be pretty apparent that night. I don't think that you're going to have a lot of question in your mind about who won by midnight on a third. I just, if I'm wrong about this, it will just blow my mind. And the only conclusion I would have is that millions of ballots disappeared. But I don't know how they would do it. I just don't know how they would do it. Oh, you're in Georgia voting for Biden? Yeah. I just don't see. I mean, the lines in Georgia. Did you have to stand in line to vote, or did you find a drop box? That doesn't mean there won't be a power struggle. He might try to get everything thrown out. But who knows? In any case, I think we're done. Swinging for the fences. I think this is a very good piece. Option selling ideas, I think, are very good. And I am getting close to the top REITs. I've been studying these REITs for a year now. And I think you'd be amazed that if you actually read the reports and you take a look at their actual properties and you figure out their cash flows, and then you go to that next level of looking at the companies that they're doing business with, then you can really go, wow, that's multiple layers of risk, and you got to figure out that they have it all set up right. So what I'm going to do is I'm going to have around 20 ETFs that you can pick from to build your own REIT ETF. All right. Everybody have a great rest of the week. Keep an eye on this market. If you can find a way to hedge with those oil stocks or SPY, I think you should do. I think some of you bought SPY last week when I did. But I do. I mean, that chart, I tell you, there's a long way down to come for QQQ, and they can all come down. I mean, the SPY range is down here. So don't think that this can't happen. I mean, a lot of people thought that this couldn't happen. A lot of people thought that this couldn't happen. A lot of people thought that the market couldn't go sideways for 2 years. This stuff happens. All right, take it easy. Keep your powder dry. Wait for the reds of their eyes to shoot.